signs of trouble for Tesla. Morgan Stanley cut its worst case forecast for the stock from $97 to $10. The stock is already down 38% year to date, and today is trading at 203.30, down another 2% or so. Joining us is Emily McCormick. Emily, why did Morgan Stanley cut that forecast?
Well, the main reason behind this bearish call that we have out today is what Morgan Stanley analyst Adam Jonas called a risk of contagion to fundamentals. So Jonas said Tesla's share price performance has been driven by three major factors. So that's one, demand for its products, two, ability to generate cash flow, and then three, access to capital markets. So this year there has been evidence that there has been significant decline in demand for some of Tesla's vehicles, and that's coming because of that missed deliveries expectations in the first quarter. So first quarter deliveries came out to 63,000 versus the 76,000 expected. That also coincided with a reduction in the electric vehicle tax subsidy that had been helping incentivize buyers to purchase some of these vehicles. That incentive is also going to have again later this year. And then second, Tesla reported free cash outflow of more than $900 million in its most recent quarter. And its cash position was reduced by $1.5 billion from the end of 2018 to $2.2 billion. So that's something that a lot of analysts have also been fixating on. And the third point is about access to capital markets. So again, Tesla did raise debt and equity, or announced that it will be raising debt and equity of more than $2 billion at the start of this month. But CEO Elon Musk told employees that even with this, the company will need to introduce, quote, hardcore cost-cutting measures to avoid running out of cash in the next 10 months. So again, demand really is at the heart of this story. And with more vehicles getting sold, this would solve a lot of Tesla's cash issues. But what Jonas said is that tapping into new demand could require aggressively expanding into the Chinese domestic market, lower price SUVs, and logistics and mobility fleets.
You know, we had Dan Ives on yesterday who said that Tesla faces a perfect storm and has to navigate this perfectly. If I'm an investor and I hear that, you know, how do you restore my confidence that Tesla can do this?
Yeah, well, I think it's really two main issues. So again, number one is that demand story. So that's going to be really about bringing people back to the vehicles and having confidence also in the company. So that's the second point, is just about managerial discipline. So one of the things that Dan Ives with Wedbush said is that the company needs to stop focusing so much on sci-fi projects and going into things like insurance or autonomous vehicles and robo-taxis, and really focus on bringing that electric vehicle to the mass market.
All right. Thank you so much, Emily. Appreciate it. Just want to get a quick comment from the panel on this. Rick, I know you pay pretty close attention to Tesla. What do you think here? $10?
I think there are two things going on. First is the fundamentals, which Emily did a great job just summarizing. They're not selling enough cars to make the money they need to in terms of cash flow and profitability. I think something else intangible is happening, which is this aura of blind faith that investors have had in Elon Musk. I think this is ending. You know, Tesla is a love-hate stock. The true believers think it's going to 1 million, and the true doubters think it's going to 0. And it sounds like the true believers are starting to have their doubts. And I think you can go back to last August when Elon Musk had this tweet about taking the company private, which turned out to be completely bogus. And all the times he's missed deadlines. He's now saying they're going to have a fleet of robo-taxis by 2020. There's no chance they're going to have a fleet of
value. I
robo-taxis
mean, the note today that's talked about the potential, and it was a rare potential to go to $10, talked about the value of the company. There's technology, there's an infrastructure that exceeds what others are trying to do.
I don't know. I have always been a skeptic on this, and for those reasons, Adam. Like the notion that Tesla somehow has outpaced every other company out there on technology and on infrastructure just doesn't ring true to me. Because of these fundamental, persistent problems, you can't really get away from the fact that Tesla has had all these promises that it hasn't delivered on year after year after year. And it has this dramatic CEO that creates extraneous problems for them, you know, every other quarter. So those are some pretty big barriers for a company even like Tesla to overcome.
Yeah, the market has treated Tesla as a tech company whose main investments are in intellectual property and software and things like that. In reality, Tesla is that, but it's also a manufacturing company with very high fixed costs. Manufacturing companies tend to have very low profit margins for those reasons, and it feels like the reality is hitting investors that this is a company that bends metal and has to bear a lot of expense just to build the cars. It's very complicated to do that.